Well, my name is Rich Harvey, CEO of Propertybuyer, and thank you so much for joining us today on our 2023 property market outlook. I'm delighted today to introduce Alan Oster, who's the Chief Economist of National Australia Bank with us. So great to have you, Alan.
Thanks, Rich.
And Alan will be taking us through the latest figures on what is happening in the Australian economy. Are we going to weather the storm? Will we see a recession? And many other questions. I will then be talking after Alan's presentation about the property market outlook, and we'd very much like to invite any of your questions today. So we do want to make this interactive. So as we're going through the presentation, if you see something or a slide or something that piques your interest and you've got a question, in the bottom of the screen there's the Q&A box. Just jot your question there, whether it's big or small. We're happy to answer all questions. And Alan, any really difficult questions?
I'll pass to you.
Right? No, we're really happy to tackle all of them, but please, It'll be a great presentation. We will be recording this and sending this around, and we will be able to provide a PDF copy of the slides as well. So, but look, without further ado, Alan, thank you so much for offering your time today. Please share your screen, and love you to take us through where we're going to be heading through the waters next year in the Australian economy.
Okay, thanks, Rich. So what I'm going to do is talk a little bit about the global economy first, then talk a little bit about what we're seeing. And one of the things that's interesting, I've been in forecasting a long time, is the amount of data we've now got and our own data. And I'll show you that. And basically, we can see what's happened as of last Saturday. So it takes us about 3 or 4 days after the end of the weekend before we know what's happened. And so that's real life, essentially, starting points as to where we're at. So what I'm going to do now is just move along a bit and talk a little bit about the global economy. And there's 3 reasons I'm sort of pretty bearish about the global outlook. First is, you're probably aware, China keeps closing their economy down because of their virus or their vaccine that doesn't work against Omicron. Now, they're talking about not being quite as strict as what they were, which might help a bit next year, but it has taken Chinese growth down to about 3%, and that is getting really low.
I mean, we've been used to a rate of, 6%, 7%?
Yeah, at least. Right? Yeah, they're still aiming for 6%. And, over the last 10 years, they've been averaging closer to 10 in a good day. So this is quite a weak Chinese economy, and people are quite worried. And, we think maybe if they get rid of this or allow other vaccines in, they might get 5% growth next year. But China is stalling at present. And then, of course, you've got the Russian-Ukraine war, what that does to gas and energy costs, what it does to fertilizer costs, etc., wheat, etc. So people forget that Russia and Ukraine provide about 20% of the world's wheat. And so that has a big impact on terms of that. And then finally, and I've said in the US, but basically we've got a whole range of central banks who are very aggressive. And so the Fed did 50 basis points this morning. We basically look at the US, and they're talking about, so they're 4.25, 4.5, and they're talking now of getting up to 5. So they're talking about up to another 75 basis points at a time where you don't really know the impact of what you've already done. I think it's really important for people to remember that it takes 12 to 18 months before we actually see the full impact of monetary policy. And that's true in Australia as well. And they only started increasing, I think it was March this year. So you're still flying blind. And then particularly in the US, if I sort of put up another slide, this is just we have models, and black is sort of what actually happened, red is what the model wants. Obviously, it doesn't work through COVID. But the important point is it's saying that the main slowdown in the US is next year, not this year. And this year, you've already had a couple of quarters that are negative, and domestic demand is still going backwards in the US. And so we're expecting very little growth in the US next year. And one of the things that the Fed did overnight was it lowered its growth forecast from 1.25 to about 0.5. for next year. And we basically, if I move up, basically we have 0.2, which basically says no growth at all. And, you know, we basically also essentially, if you look at the big economies of the world, US 0.2, Europe 0.3, UK minus 0.6, even in places like Latin America, essentially not much. And outside of China in Asia, from 4 down to 2.5. So 2023, we think, is a very sour year. If you look at the chart on the right-hand side, sure, COVID was worse, and so was the GFC, but it's the outside of those two, it's the worst since 1993. So this is a headwind that is serious, particularly for the mining, etc. And Australia, one of the things people do need to remember about Australia is that it's a net exporter of energy. So if you're digging iron ore out of the ground, and I'll be generous, $20 a tonne, and you're selling it for 110, highly profitable. And the same sort of thing for gas, although that's been clipped a little bit as we talk. Just one other slide before I talk a little bit more about Australia. This is basically, So I'm going to give you now sort of a summary of what we're seeing. We are expecting to see a big slowdown in growth from something like 2.5 through the course of this year to something like 1 or 0.7 actually. So we have essentially growth halving or more than that. Key drivers, the rate rises and also the slowing global economy. Just one important point to realise is banks take a while before they fully pass on the increase in rates. So you don't necessarily, so they're on average, they're about 3 months behind where the actual Reserve Bank is. Now, you might say, oh, I've put the rates up, but you don't necessarily have to pay them yet, if I can put it that way. And we're talking about, if we'll talk a little bit about rates in a minute, but, you know, best part of $1,000 a month extra for a lot of people next year. And there's a big cliff coming about, 2 years ago, everyone was going to 2% or lower in a fixed loan. Most of those, or the big proportion of them, roll in the middle of the year. So that's another big driver. For unemployment, still pretty strong. Unemployment's about a 6 months lag to activity. If we think the economy is going to start to slow soon, then it's probably you're going to stay where we are for about 6 months, and then gradually unemployment goes up. But even by 24, we've still got it at about 4.5, which is pretty low. Inflation peaking soon, but relatively high. So we've got headline of 8 and core of around about 6.75. So higher energy costs are still important. So that, yes, they put a cap on it, but still they're talking, 25, 30% increases. And wages is picking up. One of the things that we're seeing in the survey is it's almost impossible to get suitable labour. And so eventually that shows through up into wages. And on the RBA, we think based on what we're seeing, unless the economy slows really quickly between now and February, and I'll talk about what we're seeing, it's not slowing much yet. We've got another 25 points in February and another 25 points in March, which takes us to 3.6 compared to a 3.1 at present. Thereafter, I think the economy will slow. And then they'll be basically sitting and watching and maybe rate cutting by 24. So that's just...
Alan, just a quick question, if I may. You say that the rates take around 12 to 18 months to filter through the economy.
Yep.
I've heard other economists say it's 6 to 9 months. Why do you think it takes more than a year?
Because I've been doing this thing for 30 odd years, and econometrically, that's the relationship.
Right.
And, you do have periods before. So Australia will pass through quicker than the US, because in the US they have 30-year mortgages that are attached to the 30-year bond. And so you won't refinance your mortgage unless you really have to, because it's going to cost you a lot more money. So it takes you harder. But less than 6 months, haven't seen it ever. Always takes longer. And I can go into a little bit more detail in a minute. For example, I'll give you the view. Now, NAB has different rules. everybody has their own rules, but in NAB, you don't have to start paying until you come up to your annual review. So if you did an annual review in May, you wouldn't actually have to pay anything until May next year. Now, what happens when you come May next year? You've got a hell of a lot to catch up on. But so there is a lag that's important. And people can say, oh, stuff this, I'm going to enjoy Christmas. And they keep going. All right. So on the currency, you know, our models plus or minus 5 cents are about as good as you get. And what we're basically saying, the reason that the Australian dollar fell pretty significantly was everybody went back to the US. And why did they go back to the US? Because when you're in trouble globally, most people go back and buy US Treasury. Completely irrational, but that's what they do. And so we're basically seeing the currency going back to mid-70s over the next 2 years, if I can put it that way. So now I want to talk a little bit about some of our data. And there's sort of 3 or 4 types of data. On the NAB data, it covers 3 areas. Number 1 area it covers is every electronic transaction that goes across our systems. So 5 million transactions a day. And as I said, we can see it within a week. Second data is we can see everything associated with NAB customers in the business bank. So that's about 30% of business. And we can see their revenue. Now, they may be lying to us, but as long as they're lying to us the same amount as what they've done in the past, we can see their data. And we can see it weekly. And then the third thing we look at is we look at cash flow from NAB customers. So this is a smaller sample. So this will be about 15% of the system. But we can see what's coming in, what's going out. And in particular, we can see where it's coming from. And so we can see people who are being paid the dole. And so we can get what was called a claimant count, i.e. a number of people being paid the dole in a pretty big sample as of last Saturday. So let me then sort of talk a little bit about the data. So first off, here's a sort of summary. It's monthly. It came out yesterday. And if you look at what I've circled there, retail in the month of, and the reason we use monthly is weekly data is fine, except there's a weekly pattern and it's really hard to seasonally adjust weekly data. Number 1, some weekly data moves around, like Easter, like Chinese New Year, and other things, seasonal factors have difficulty with, like Black Friday. Now, if you look at the data, you'd see under that retail in the middle there, it sort of jumped up in November. And basically, the reason it jumped up was Black Friday, and I'll show you some of that in a minute. But if you look down in total spending, which includes other services, you see a range of weaker numbers, particularly in things like health, education, etc. So yes, we're getting some growth, but not a lot in nominal terms. And you can see on the right there, the sort of charts, and, you know, hospitality has been quite strong. Vehicles and fuel are very strong. So if you like, part of that story is people have been ordering these cars for ages and haven't been able to pick them up, and now things arrive. And so I always use my own example. So not a car, but a dishwasher. We ordered it in July. It arrived yesterday out of Europe. If I'd known, I would have bought an Asian one. But basically, it's sort of saying, nah, hard to tell. If you look at weekly data, if you look at the columns up there, total spending. So I'm talking here, the 11th of November, the 26th and the 3rd. The last one includes essentially Black Friday in full. And the 26th to the 11th include a little bit of it. So where is it really strong? If you're looking at that table, retail is really strong. Hospitality is not. So what we're sort of seeing is some easing back in hospitality, big increases in retail, which looks to us as it's Black Friday. So we can see electronics underneath it all. And in state data, it's all pretty similar. This is a graph just showing you how it looks through the course of time. And again, you can see that hospitality that was booming is coming back a bit. And if you look at the state data, they tend to move together, albeit the New South Wales and Victoria are right up there. So the big guys are doing well. Now, so that's sort of a story that says, well, it may be just starting to slow, and it's really difficult to seasonally adjust for Black Friday. It's been around for a while, but normally takes seasonal factors a couple of years. If we look under some of our data, the data subsequent to Black Friday has been a bit softer. So I'll make a bit of a bet. My bet is retail sales in seasonally adjusted terms in December month, which we'll get in January sometime, will be negative, because they'll be looking for, in the seasonal factors for Christmas presents, that were actually bought in November. So it's, it's difficult to say, is the economy slowing or is it not? And this gives you some feel of Black Fridays. And so I've just used the sort of growth rates, the kick relative to previous years. And so 2019, you got a kick that was really significant. And, you're up around 15%. Now you're down to about 5%. So, Black Friday is still important, but it's not the kick that it used to be, is sort of the bottom line in some of this. Okay. So now we're looking at what's happening to revenue. And so if you just use on the top left-hand there, the total increase in revenue is about 10.7% up. What's really strong? Utilities, i.e. energy, communications, mining, really strong. Then you get down the bottom, rental. And then you get back to retail, it's sort of middle of the pack, up about 10%. And then there's a chart there showing the 4-week moving average and the 3-month moving. The red kick is Black Friday, right at the end. Now, the other way we can look at the data, rather than looking at it this way, is to say, well, how is the various sectors going compared to where the growth rate was from the beginning of the year? In other words, we're trying to get an estimate using the weekly seasonal patterns. Red is this year. Black dotted line is 2019. And so what you're seeing is that there is a seasonal pattern here, weekly. And the end of the financial year this year was really strong. And if you look at Black Friday, they're really strong in terms of the money coming in the red line. But now you come beyond Black Friday, because this is data essentially till about the 14th of December, 13th of December, last Saturday, and it's come back to normal. So we will basically say what this is saying is revenue is still pretty good. And we're then going to turn now to our business survey. 1,000 firms each month. It's considered the best business survey in Australia, not because I built it, but because essentially it's been tracking really well. And this is interesting. So there's 3 things in this chart, and I'm looking at the compared to long-term average. If I look at business outcomes, so employment, profits, trading conditions, that's blue. It's still really, really high. And that's November. You look at the green, which is forward orders. It's still high, but it's come off a lot. And then you look at business confidence, and it's negative. And the gap between outcomes and confidence is the second biggest of all time in this survey. And the survey goes back to the 80s. And so the only other time there was a bigger gap was basically the first month of COVID. And you can see there the red line just disappearing off the chart. So this is what the survey is sort of saying to us is things are still good, but Jesus, there's no confidence they're going to stay good. And you can sort of see this also. Blue line there is actual outcomes by industry. So mining's doing good, transport's doing good, personal recreational services, so that's like hospitality, is still doing good, retail, wholesale. But look at the red lines. The red lines for those industries that are growing best are pretty awful. And mining doesn't look like there's a red line because it's 0. So the fastest growing sector we've got, called mining, there's a 50-50 split between those who think things are going to get better and those who think things are going to get worse, which is really, really unusual. So what they're saying is things are good, but we worry, is sort of the bottom line. Then just a quick one. Again, by state, it doesn't really matter. They're all pretty much the same. Queensland had a bit of a recovery post the floods, but New South Wales and Victoria are still pretty strong. Then you also get this chart. So left-hand side is purchase costs. Now, the red line through the middle there says on average purchase costs per quarter about 1% per quarter. At present, they're going 4% per quarter. So that's sort of saying it's going 16% per annum. Now, if you're an optimist, you might say, it's come back a bit. If you're a pessimist, you'd say, well, it's bloody high. And then the right-hand side shows you product prices, including retail prices, the same sort of story. So what we're seeing is that the economy, according to the business survey and basically our data, says economy is all right, and people are using, or businesses are using that demand to fully pass on purchase costs, and profits then stay pretty high. But they're sort of worried that this ain't going to continue for a long time. Okay, if you look at the blue line here, blue line is how hard is it to get suitable labour, and it's on the left-hand scale there. So during the mining boom, the record was 50% of people said the number one problem was, I can't get suitable labour. Where are we today? 90% say, I can't get suitable labour. Not a great correlation with wages, but it's sort of saying it's going to come. And we expect wages growth to pick up to around 4% during the course of next year. Inflation. Red is headline, and we've got it up at 8%. Then the core is basically what's called a trim mean. So we extract from that headline the top 15% of price increases, and we also extract the top or bottom 15% of price falls, and you average the rest. And that's what the Reserve Bank's targeting. And the sort of line between 2 and 3 is their target. So we see that prices will stay very high for a really long time. Hopefully by the end of 24, they'll be back around the top of the Reserve Bank's target. So, purchase costs, they're a bit better. Maybe they'll come off a bit quicker than we thought, but I think it's going to take a while. So you've got energy prices, you've got issues about wages flowing into prices, etc. So that keeps things up. Okay, so now we're talking about property or resi. So when I was at the OECD, what we used to do is we didn't use a 12 months too, because there's a lot of history in that, and sometimes they revise recent data. So you look at the last 6 months and you annualise it. So the headline data says that house prices in Australia this year fell 4%. But if you look at the 6 months annualised rate in Sydney, it's down 20%. So it's a turning point perspective. And then you look at everywhere else other than Tassie, house prices have come down a lot. And we continue to see that to happen. In terms of what are our expectations, the purple line there is what we're expecting. We're expecting another 14% fall in house prices after the 4% all there about fall this year. Now the good news for those who get worried by this chart is the red line, because the red line basically tells you that in the 12 to 18 months past, house prices went up 20-odd%. So where you're going to be is more like unchanged relative to a 3 or 4 year period. Now, that doesn't mean that you can ignore it. It does mean that people are going to have to be interesting in terms of how they behave. And one of the big issues out there is you can't just use models in this. It's not the number of people who are going to fall over because of rates. It's going to be, what will people's response be if they see their main asset going down big time and they're paying $1,000 a month extra to service their mortgage? So not that they fall over, but do they slow their spending? And we think the answer to that is yes, they will slow their spending significantly. Cash flow. Red line is, again, it's a trim mean, but red line is spending by consumers. Black line is basically almost zero. And what is that? That's their cash flow. So what it sort of says is the guy in the street, on average, is spending every penny they've currently got. And when they get their $1,000 a month extra, that sort of makes me worry that consumers will slow big time. Paradox of thrift, it's called. Everybody gets thrifty, economy goes down the toilet, is sort of the bottom line. Okay, where are they going to do it? So this is a sentiment indicator. So we're trying to say, we've just taken this. This is a measure called a stress indicator, and we flogged it straight out of the UK because they do a lot of interesting stuff. The green line there is the cost of living. The black line is basically the total stress that people are recording. And the white line is, I'm worried I'm going to lose my job. So we don't see a lot of, unlike consumer sentiment indicators, we don't see consumers as being incredibly worried net, because what they're saying is, I'll keep my job. And if I have to, I'll get 2 jobs. And so that is a dynamic that I think that is important. Where might they start to slow their spending? Well, if you're looking at the brown line, it's sort of saying holidays. If you're looking at the black line, it's major household goods. There's a line there, the second bottom one is private school fees. So I'm going to send them to the locals. I'm not going to send it to private schools. But generally, they're indicating they're going to slow everywhere. But anything that's discretionary is really in the gun as we go forward. And one of the things that we try to look for, but it's difficult to find, is are people switching from, let's call it upmarket takeaway food to downmarket takeaway food. So in the old days, they'd say they buy chickens rather than meat. And the dogs aren't getting bones anymore. They're getting pretty crappy stuff. All right, so what's our forecast going forward? The black line there is year average or through the year growth, and it bounces up and down because, this time last year, you basically were all locked down. And the red line is the quarterly growth numbers. And our forecasts basically have, by the end of next year, an economy that gets very close to flatlining. Doesn't quite, but that's sort of what we're watching for. If you're looking at our models, black is actual, and again, it's like that US model I showed you before. They don't work during COVID. But again, they sort of, if you look really carefully at that red line, which is the model, it sort of wants slightly negative towards the end of next year. This is our cash flow, our claimant count. So it's basically the orange line is the number of NAB people who are being paid the dole, and the black and the blue line there is basically the level of unemployment, which came out today unchanged at 3.4. But what it's basically sort of saying to you is that for a long time, the labour market's been getting tighter, and we don't see it getting any signs there at all. It's getting less tight. And so we, again, as I said, we'd expect unemployment to stay roughly where it is for another 6 months or so. What do we expect unemployment to do? Well, this is what I've sort of said before. We expect unemployment to start to rise, but it's still at a pretty good outcome. And I think it's worth saying that, if I've got major recessions in the US, UK, Europe, big slowdowns in Asia, Australia growing with unemployment around 4%, and inflation near the top of the range of where the RBA wants it by the end of 24, that's a pretty good outcome. And before I make everybody pessimistic by what I've just said before, I think once you get through that, Australia has not been damaged anywhere as much as what you're seeing offshore. So if I took a graph of Australian GDP versus every other country, Australia's on the top. And so I think in a couple of years' time, people will look around and say, well, it's a good country to live in, to invest and employ. So I'm quite optimistic about the medium term. But in the meantime, you've got to worry about what's actually happening now. And so just on RBA, and Rich, this is my final slide, so I'm going to move over to you. But basically, provided you don't get a really big slowing, and it's unlikely, the RBA next meets in February. So you'll get more data, but I think you're probably going to find some slowing, but not a lot. You're going to find very high inflation coming out a week before the RBA meets. So you get the December CPI a week before they meet in February. And so we've got 2 more 25 basis point increases. Then we basically stop, and then we have rate cuts from early 2024. What chance of a recession? I'll give you 40% chance. I'll give you 60% chance it won't. But this is not a minimal chance anymore. This is almost 50-50. But I'm still at this stage on the camp that says maybe we might just get away with it. But I do think the idea that you have mild recessions, which a lot of people talk about offshore, I've never seen a mild recession. And so I think you just need to be pretty careful. So, Rich, I might stop there.
Thank you so much, Alan. That was fantastic. Really appreciate you you sharing your insights. It's been very, very helpful. And people, all your viewers there, if you do have any questions, please just go to the Q&A section at the bottom of the screen, fill in your question, and we will get to it after my presentation, which goes for around about 20 minutes or so. And we do, please stay around for the Q&A because there is a lot to share there. So I'm just going to share my screen now. I'll just bring this up and we'll get straight into the next section. So just straight off the back of that, really great insights there, Alan. Straight off the back of that, I also have a couple of charts that I'd like to share with you. And just looking forward, what I want to do in this part of the presentation is give you a property market snapshot, particularly where we're at, where things are heading to, 8 things to look out for in the coming year, and just give you a bit of a flavour for a couple of case studies, and then we'll open it up for Q&A. I think a lot of you on the Zoom call have already probably seen some of my presentations, but for those who haven't, I've been in business for 21 years, purely as a buyer's agent, working purely for the purchaser. And my company has won over 40 awards for excellence. And I've also served voluntarily as the chairman of the buyer's agent chapter for the Real Estate Institute and been the president of REBA. So let's get into it. Where did we finish up in 2022? It's been a fascinating year in property. So I did reach out to my colleagues at CoreLogic, and I know there's a lot of numbers to digest here, but just let me give you a little flavour here for where we've ended up. I wanted to particularly look at a bit, I think one of your charts too, Alan, you had both not just a 6-month, but a 12-month and 2-year, sort of looking backward over the past whole COVID period. And if you look at the values here for Sydney, Melbourne, we're seeing Sydney's housing prices have finished up at around 1.2 million. Melbourne's at 915, Brisbane just under 800,000. And if you look at what we call peak to trough pricing, I mean, often the media gets very caught up in just the most recent headlines about prices have plummeted, and yes, they are declined, but the rate of decline is slowing. That's what I'm seeing in a lot of the figures. And again, Sydney and Melbourne are at a very different stage to Brisbane or Adelaide or Perth. They're very, very different markets, all operating with different drivers. So it's important to look at where the markets have peaked and where they're going to bottom out. And we'll come to that in a few moments. So that's where we've ended up this year. And also for apartments, fairly similar range of figures, except median value in Sydney now for an apartment is 780,000. In Melbourne, it's just under 600,000. In Brisbane, just under 500,000. So it'll be interesting to see where the affordable markets will be in the coming year. Now, if we look at change in dwelling values here on a sort of a period of time from pre-COVID to post-COVID, if you like, you can see there's some really interesting trends here. So obviously, monthly values after COVID hit, very beginning of 2020. We can see that prices were going up at 2 to 3% a month at one point there. It was just insane. I've never in my career seen prices rise so rapidly. And then we saw APRA certainly tighten up some of the serviceability assessments, and then we can see the obvious impact of when the cash rate starts to rise, just how much that's impacting property demand and particularly borrowing capacity, which I'll talk about in a few moments as well. If we look at the auction clearance rates, what's been surprising me is just the resilience of the property market, particularly around auctions. I would have expected to see the auctions dip well below the 60% mark. But last weekend, Sydney, we had an auction clearance rate of 65%, Melbourne 62%, and Brisbane 61%. So still tracking along. I mean, there are lower volumes. Melbourne did have 1,000 auctions though, so that was a pretty decent number. That was quite significant. And we've got one more weekend of auctions before the end of the year, but it'll be very much a low numbers this coming weekend. But looking at trends for both Sydney and Melbourne, you can see during that period there, where it was really the peak of the market in that, October, September period of 2021 there, we were seeing clearance rates of around close to 90%. And then they've really dipped back to sort of the mid to low 60% over the course of this year. In Melbourne, similar feature. We saw again the auction clearance rates trending around sort of high 50s, low 60% for most of this year. Obviously, a bit higher in March when we started the year with a bit more positivity, but certainly dipping back to that sort of low 60% market. One of the charts that CoreLogic put out that's quite interesting is the comparing this decline to previous declines or peak to trough, like peak of the market to the bottom of the market. And obviously, because we've had the most aggressive rate rises, that's correlated naturally with one of the sharpest declines in the property market. So this is a national figure, which hides a lot of variations, but you can see here this steep blue line, we're down, according to the national dwelling values, around 7%. But I'd expect that sort of rate of decline to decelerate and will start to flatline at some point next year. So what are the themes likely for the coming year? What are we going to see? Obviously, I believe interest rates will peak, very much like what Alan is saying. We'll see price falls start to stabilise. The market will find a bottom, or a trough as we call it. We're going to see rents rising. Mortgage rates are going to get higher, so there's tougher lending. But on the flip side, Australia is a very, very attractive place to live, and massive migration wave is coming. So let's have a look at each of some of these figures. I've got 8 things we're going to be looking at today. So I believe the terminal cash rate's going to hit either one more rate rise or possibly one more. So either 3.35 or 3.6. Now we know inflation has pretty much peaked, but my question is how fast will it come off? That's going to be the one to watch, and that will also determine a lot of the RBA's modus operandi going forward. They've said they're going to do everything possible. They're throwing everything at it to get it down. That's Dr. Lowe's mission in life. So mortgage pain, definitely more mortgage pain ahead. As the RBA keeps jacking up rates, there's certainly the banks are passing it on in 3 nanoseconds, pretty much. There's no hanging around there. So what we're going to see is, and it's already happening here, we're seeing that the trend there for both owner-occupier lending and investment lending is declining. No surprises there. It's natural response to higher cost of borrowing. But we're just getting back to where we were, back in the 2016, 2017 and beyond. We were having mortgage rates of 5.5%. We've just been used to this diet of cheap money. So now we're just going to see that borrowing capacity is reduced and living with that higher cost of borrowing. I mentioned the migration wave. So this in many ways is a saviour and a very strong impetus for economic growth in Australia. Without migration, we would go backwards. We're not having enough babies to keep up with the demand that we all need. What did Peter Costello say? One for the family and one for the country. Was that right? Something like that. But if you look at NOM, net overseas migration, you can see here this blue line is the net overseas migration here. But, the cap was lifted to 195,000 migrants per annum. I still think that's too low. And on top of that, you've got all the temporary visa holders. I think to really address the unemployment problem and the labour shortages, we need to increase that cap. But that's going to also put a real pressure on our rental market. We've already got, it's difficulty with our rents, but we are short of so many skilled workers in this country. COVID's really decimated that. So we're very much going to need to increase our migration to be competitive on the world stage. So talking of rents, if you play Monopoly, you know that you've got to pay rent every time you land on a square. Well, if you're a renter in this country, unfortunately, it's going to become more difficult in the coming year. Certainly, we've seen rents rise nationally on average 10%. Adelaide's gone up 13%, Brisbane 13.5%. Like the vacancy rate in Brisbane at the moment is 0.7%. Very, very difficult to get rentals. So great if you're an investor. And that's why I bought a couple of properties up there this year. It's really good to be active in the market if you can be. So that will be one of the things that's going to attract investors back into the market. The other thing to watch next year, as I said, borrowing capacity reduced. Since April, all of the modelling has been done by PropTech is showing that borrowing capacity is reduced to at least 22%. And with a further 2 rate rises to come, we're going to see that crimped even more. So this is the dilemma the average buyer or investor has, is if you keep waiting to sort of pick the perfect time to buy, then your capacity is going to keep reducing. But prices are also correcting. But typically, I think I've found that prices have not corrected as in the same rate as which your borrowing capacity has declined. So here with our seesaw, you're going to find your borrowing capacity has gone down even lower. And this is the analysis done by PropTech. This is showing that for each rate hike that we've seen, whether it's 0.5% or 0.25%, that the cumulative change in borrowing capacity here is at 21.6%. So it's really reduced borrowing capacity quite significantly. Whereas back in April, you could borrow, say, $2 million. Now you can borrow $1.56 million. If you're trying to borrow $500,000 back in April, now you can only borrow $391,000. So that has a direct flow-on effect into people's ability to bid at auction and pay top dollars. Right, so we talked about investors coming back, definitely lured by rising yields, but we're also going to be seeing, the massive shortage of accommodation there is another driver. So there's less competition from other investors out there. But for me, property is a great hedge against inflation. I think it's a wonderful thing to have in your portfolio. It's a good defensive asset. You get capital growth and yield. So I think it's going to be drawing a lot more investors back, even despite the higher cost of borrowing. My view is it's still a great time to be borrowing money and getting into the market. I want to talk about expats and exchange rates. So we've seen that the exchange rate really has declined roughly about 10% over the last 12 months. So a great opportunity for investors to potentially notice these expats to get into the market and have a currency play. And talking to a couple of colleagues the other day at Compass Global, they're suggesting that we're going to see, a bit similar to your model, Alan, too, the dollar range will probably be between 71 to 74 cents during the next financial year. So not a huge rapid volatility. But, one of the things with the expats is that it's very expensive living in places like Hong Kong and Singapore. I was reading the other day, if you want to own a car and get a permit to have a car in Singapore, it's going to cost you around almost $100 grand, $98,000 a year, just to have the privilege of driving your car around Singapore. And that's why most people use public transport. The cost of housing and rents is astronomical. It's just really phenomenal. You would have read a few articles in the financial papers about how much it's costing to live there. So my view is that some expats will get frustrated with that. You know what? I'm going to come home, even though it's a pretty decent lifestyle and tax advantages. I'm just tired of this. So I do think we're going to see a continued flow of expats returning home to spend time and raise their kids back in Australia. Another phenomenon to watch out for is what I call regional regret. There was a survey done by Real Insurance and Core Data just recently of 5,000 people. And they discovered that around 68% of people are going to make a move, who made a move, actually now regret making that move. So these are the findings. And that, 23% of those people are actually starting to move. 36% of those people are already moving, and another 23% are going to be doing that move back to the city areas over the next year or two. And the reason being is that it just didn't meet their expectations, or they're being summoned back to the office. So I think that's a really interesting phenomenon there. But I do believe that we're still going to see strong migration, particularly to Southeast Queensland. So places like the Gold Coast, Sunshine Coast and Brisbane. northern New South Wales, where it's still a really attractive lifestyle. That's really getting the lion's share of the interstate migration around Australia. So there are 8 things to look out for next year. So what is the forecast for next year? Well, everyone's got their crystal ball. I'm going to put up Louis Christopher's projections. He's from SQM Research. Yeah, he doesn't always get it right, but he tends to have, like all good economists, a whole bunch of assumptions around which is his one. So surprisingly, he's suggesting they're quite significant increases. I can see you laughing there, Alan. We'll get your comments in a minute, but
Yeah.
you know, I actually think this is a bit too bullish myself. I don't think we're going to start to see really significant increases in property prices till the back end of 2023 or even early 24, until we start to see cash rate cuts again. So
Yeah.
I'm curious to see that he's put up here that he reckons that Sydney will grow on his base case of interest rates peaking no higher than 4%, inflation falls back to 5%, and unemployment stays below 5%. That you'll see Brisbane rising 1 to 5% next year, Melbourne 1 to 5%, and Sydney 5% to 9%. So pretty phenomenal increases if that were the case. So anyway, what's your thoughts on that one, Alan? I'll get your comments now on that one.
Well, I think scenario 1 is pretty close to our forecast, but to get a 3 to 7% increase, I think is stretching it a bit. I don't think you're going to see increases in rates, increases in house prices like you until they start cutting. So I'd be happy to say, 7%, but I'd put it in 2024.
Yeah.
Not this year.
Well, what's going to be interesting, we did see the market pivot extremely quickly at the beginning of 2020. So between March 2020 to sort of May 2020, everyone thought the sky was falling. And then we really just saw the market take off. It was phenomenal. But the big headwind, obviously, the big drag is going to be the cost of borrowing. So unless that changes dramatically and the cost of living comes down, I don't think it's going to respond nearly as quickly as what it did in the past.
Yeah. Well, the other thing to also remember is you've got a large chunk of fixed loans mature.
The fiscal cliff, yeah.
The fiscal cliff. And so for NAB, it's $6 billion in June.
Yeah.
That's the peak.
Yeah. So that's going to be interesting to see.
Yeah.
All right, so there's a couple of forecasts there, folks. What I'm going to do now is just talk a little bit about some case studies and what you can do to help position yourself to take advantage of the market going forward in 2023. Whether you use us as your buyer's agent or whether you do it on your own, these are the key steps you need to take in considering about buying a property. You've got to start with developing your own strategy, identifying the right research to rely upon, and that's why obviously you're attending a seminar like today. You need to shortlist and find suitable properties. You need to evaluate them. You need to then complete your due diligence, do your pest and build inspection reports, rental appraisals, etc. And then you need to step in and negotiate and secure that property and get it exchanged or bid at auction. And the last step is your settlement and organising your property manager. So there's your 7 key steps. If you are thinking about using a buyer's agent like ourselves, we'd certainly be delighted to help you. Very happy to have a no obligation chat. But these are some of the key benefits that you get in working with us on your side. We'll simply give you a really clear roadmap on how to get ahead and achieve your goals. We give you access to a lot of off-market opportunities, save you huge amounts of time, give you our local buyer's agent who's got the real insight and knowledge to the local areas. We'll help you crunch the numbers, tell you what the property's worth, and essentially give you much greater confidence in making a good buying decision. So how do we charge for that? We typically work on a fixed fee basis. It ranges between 1.5% to 2%, depending on the price range you're buying in, but we have a full schedule of fixed fees we can give you. You'll pay an engagement fee of between $3,000 to $5,000 up front, and then the balance of the fee on exchange of contracts. But as I say, it gives you that access to the off markets. It really fast tracks it, and you've got a professional negotiator working side by side with you every step of the way. So Brooke in our team and Pete in our team can give you more information on that. What I'll do toward the end of my presentation now is just give you a couple of case studies. I'm not going to go through all of them because I do want to open it up to a really good Q&A session. But I'll just give you a couple of case studies on why I think property is a great long-term asset buy. So this was a property we bought for a client back in 2007. They paid $580,000 for it. Now rents for $900 a week, and this year valued at 1.6. So just by simply holding onto a property, riding out the ups and downs of the market, there's a healthy $1 million gain. And that property is located in Carlton, just near the university in Lygon Street in Melbourne. This was a property we bought in Brisbane this year. This was listed without a price, and we managed to secure this property for $895,000. It was $40,000 below another offer. And the reason being is that we had our client's finance ready and approved, whereas the other offer, that buyer was a little bit shaky and didn't have their finance approved. Even though they were willing to offer more money, the owner decided to go with our offer. And so sometimes it's about positioning your offer and having it ready to go. And that's what enabled us to get in there. Anyway, we actually ended up achieving an even higher yield on this property than we anticipated. We got 1,020 a week and multiple applications, so giving a gross yield of 5.9%. We can also find high cash flow properties in resi. This was almost like a commercial property, to be honest, but this was an apartment on the Gold Coast, a two bed, two bath, one car apartment. We secured this off market, and we managed to achieve a net yield of 9.7%, even after all of the body corporate fees, insurances, rates, etc. So pretty significant holiday let. You do need to be very careful where you buy these properties, but if you know what you're doing, you can achieve a fantastic outcome as well. This was another property we bought for a client in Sydney. This was using a granny flat strategy. This was an existing house, 3-bedroom house with a study, and then behind the garage, there was a granny flat. So getting two forms of income, it rents for $16.90 a week. And that investor's made a healthy $1.5 million gain since 2008. But having the two forms of income has been one of the keys there to support the cash flow on that property. So if you can add a granny flat or find an existing one or renovate the house in such a way as you can get a dual income, it really does help you to hold the asset for the longer term. Duplexes are another way to smart way investors can get into the market. So again, two income streams. We bought this property for $770,000 earlier this year and managed to get a yield of 5.67%. Combined rent was $840, and that was an existing duplex that was just there. I'm not going to go through too many more examples, except to say we buy homes right across the Sydney metropolitan, Melbourne metropolitan, Brisbane, Gold Coast, Sunny Coast, Newcastle, pretty much anywhere you are looking to buy, we can assist with one of our team. What we try to do with all of our clients is treat our clients like family, and we want to save you every dollar we can. So this is an example we bought in the Hills District just recently for a client at Castle Hill. It was a lovely 6-bedroom house. We managed to save them $50,000 based off our appraisal, just by simply negotiating well. And we're starting to get even deeper discounts for our clients as the market turns as well. I'll give you a couple more examples. This was a great one we bought for our client in the inner west. We managed to save our client a massive $280,000. And that was simply by positioning our offer, moving really quickly, having all our ducks lined up with our pest and build and our solicitor review all done really well. And that was a great result. I'm going to skip through to right to the end. I'm going to put all of these in a PDF for people to look at. Just except to say, if you are interested in using our services as a buyer's agent to help you with your next property, you can follow us on socials, but please just give us a call, respond to the email that comes to you, have a chat to Brooke Rutherford, our business development manager, and really feel free to have a chat. So what I'd like to do now is keep you on the line there, Alan, and we've got a couple of Q&As to go through here. Let's have a look here. So first one is from Brooke, is saying, do we attribute business confidence to their own independent appraisal of their company forecast and to that of their peers?
Hard to tell. We've been collecting this data for 30, 40 years. I think it's really, the way we ask the question is, relative to where you are now, do you think things are going to get better or worse? And when you've got a negative number, it means there's a majority saying it's going to get worse. And so it is, I think, more about their own business rather than, how the economy is going. So, and we see, depending on how you ask the question, you can get radically different answers. So over in New Zealand, they have what I might call not a great survey, but they have confidence at -57. And their outcomes are like -10. So it can be biased, but we sort of get a feel that they're saying, this is what we think is happening to us. And so if I look at the various sectors, the sectors that are least confident tend to be retail, wholesale, and miners.
Yeah.
And that sort of makes sense in the current environment.
Yeah, great. Okay. Another question, how do you measure underemployment?
Underemployment's easy. There's underutilization is actually an official government term. So what you do is you basically take the unemployment rate, you add up those who basically have opted not to participate in the labour force, and also you add in those who are just not actively looking for a job. And so the current rate is around 13%, which is sort of a little bit below where it was pre-pandemic. In the pandemic, it got about 25. And so it's a pretty standard measure, and we look at it really carefully because that's, if you're in the middle of COVID, et cetera, and you're, I'll call it a travel agent, then nobody's traveling. And so what's the point? So it gives you a better measure. But, a lot of people don't understand what it means. But, yeah, it's something that's really important to look at.
Okay, Brenda's asking, I believe the $1,000 increases each month can also be reduced by tax and rental increases. Well, yes, I'll answer that one. The cost of your borrowing is going up. Yes, it's going to be an extra tax deduction, but it may not be going up at exactly the same rate as your rental increase. It certainly offset it, but I've got to say, I think it will. If you had a positive cash flow property, it's probably going to be eating right into it. So it's probably back to neutral or slightly negative now. It may not completely offset the extra cost there that you're holding.
Yeah.
Another question for you, Alan. As an estimate, how long do you see? So how low do you see rates going when they come off in early 24 or 25?
So we would let's assume that we're right and they go to 3.6, right? We would basically say once the economy is hitting the sort of growth rates we're talking about, RBA would want to get back to neutral, which I'll call them 2.5, 2.75, something like that. And so that's what I would expect you to see by the end of 24. So you're in a period of, they'll go up a little bit. The central bank, to be honest, is talking, and they're one of the few central banks talking about keeping things on an even keel. So think of your yachting term. I don't want to capsize us and we all sink. I want to keep it going okay. So they're much more inclined to just sit back and watch rather than the inflation zealots in particularly New Zealand and also the Fed.
Great. Excellent. Glenn, yes, you can receive a copy of the slides. We'll be sending that out to everyone along with a copy of the recording. Jeremy's asking, as your buyer's agent, you are always going to say it's a good time to buy. So when is it a bad time? Great question. Look, it is a bad time to buy when you cannot afford to buy. Like I buy properties whether the market's up, down, or sideways for myself and for my clients. So really, I'm always finding opportunities no matter what the market conditions. So a bad time to buy is when you cannot afford to buy or it doesn't suit your life circumstance. That's what I'd be saying. So there's no perfect time to buy. It's really about trying to pick when it's right for you personally, but trying to time the exact bottom of the market, Alan. What would you say to that sort of answer? What do you say to people that are trying to time perfectly their entry into the property market?
Well, my answer on properties generally is that it's a 5-year minimum investment. So whenever I'm up in Asia, and I don't go up there much now, but, the question I always used to get was interest rates, when are they going up? House prices, when are they going to go? And my answer is, if you're going to try and forecast what's going to happen in the next 6 to 12 months, I've got no idea. But if you're buying good property and you're prepared to keep it, I think generally you're fine. The only time that I'd sort of get worried is if I saw unemployment go up a lot. That would be nasty. But I don't really have that in our forecasts, and I don't think anybody has that in their forecasts. So I just think it's an investment decision over a medium term. And so buy and Rich, you might have different views, but I just think 5-year minimum.
I agree. I think definitely property is a longer term asset. I mean, if you're a developer and you're a trader, you're getting in and out, but even developers should be holding on to more of their stock. But I think the other thing to say is you do need to take a long-term view and also buy quality. I've often found that property, really quality property, is far more resilient to price declines than buying inferior property. I mean, I always say it, properties on main roads, right? Properties in poor positions next to a petrol station, next to a school or some other problem. They are always going to trade at a discount, whereas quality property, well built, well located, close to amenities, typically holds its value so much more over the long term. Another question for you, Alan. What do we see of China and Australia's trade relationship? When do we see it improving?
Short answer is I don't know. However, the main negatives for them, or for us as a result of them, we don't get students coming anymore and tourists coming, and we haven't had any. And secondly, if China falls over, it's always been, that will cause big problems for commodity prices. Well, they've tried to stop most of our exports and it hasn't worked. So, it would be great if suddenly they wanted to buy all our stuff again. I wouldn't factor that in. I think one of the lessons of the pandemic was basically don't put all your supply chain issues in one spot. Diversify. And I think Australia should be diversifying, and I think we are. And so, we look at Japan, we look at Korea, we look at Indonesia, and even the EU's interested in the free trade deal. So I think, the negative impact, we've probably had it. And I don't really expect it to improve much, so is the honest answer.
Okay. Interesting to see. Another question for you, Alan. Can you please let us know what percentage of the $6 billion in fixed loans you'd anticipate that will default?
Not many. Not many. I don't think so. A lot of we are looking really carefully. So, one of the things we do, and I'll deny it if anyone says it in public, but we look at anyone who's bought in the last 12 to 18 months, anyone who in that area who have also only got one income, not two, and anyone who's outside of, fair way out from the CBD and might have to travel in. And so far, we're not seeing any. And in some ways, in the variable home loans, a lot of them are a long way ahead. And so I don't expect to see a large element of defaults. And to give you a perspective, the default rate in the 1990 recession, which was bloody awful, was 10%. That's really not the issue. The issue is rather that if people see what's happening and say, I'm not going to spend as much, or I'm going to get second job, etc. But that can have a really big negative impact on the economy. So it's not the default per se, it's the reaction to business to saying, geez, if I don't do something, I might default.
So what you're saying is if we all seize up and we all sit on our hands and do nothing, there's no circular flow of income, therefore there's no economic growth. It's default because someone else will pick up that property and buy it and move on. Yeah.
And so it's called, in economics, it's called the paradox of thrift. Yeah. So we're all thrifty and the economy goes down the toilet because we're thrifty.
All right, another one for you, Alan. Utilities has been the highest spending at around 40% year-on-year increase. What average costs raised per family do you think families can endure given some of the government caps?
Well, you've got to put it in perspective. I think what the government's trying to do is help. And so, they're going to take about 0.5% off inflation. That's fine. But I'll give you a perspective that you probably haven't heard before. In the UK, they're trying to put a cap on electricity prices essentially at £2,500 per annum. The average consumer in the UK only gets after tax £20,000. So you're spending 15% of your income to turn the lights on. That is why the UK is in deep, deep trouble. So I think it's manageable. I think it's another one of these issues that will basically make the consumer say, Jesus, I'm spending more than I've got, so I'm going to have to change my spending behaviour a bit. So I don't think it's catastrophic at this stage. But some people will think it's catastrophic, but not to the average.
Brenda's asked a good question, Rich. If your charge rate is calculated based on purchase price, why would you still try to make the price cheaper for clients? Simple answer, Brenda, is we work on a fixed fee. So I put percentages there because I couldn't give you the whole schedule of fees. It's like a one-page fixed fee. Happy to send it to you. The reason we try to get it cheaper for our clients is we want great referrals. As I said, I drill into my team the care factor. And one of my mottos is people don't care how much you know until they know how much you care. That's sort of the philosophy that we operate by. And we want to get the best possible property at the lowest price we can for all of our clients. And that's how we've built our reputation. So we very much pride ourselves on being accurate with our appraisals and try to secure the property at the best terms and the best price and make it worthwhile. So we've got to compete with the other buyers. You've got to be competitive and you've got to beat other buyers, but you don't want to overpay. And we very much provide great advice on valuations. Glenn's asking, why don't you show the capital gains likely in the growth figures as presented? Thinks this overstates performance as shown. I'm not sure which slide he's referring to, but all of my figures are straight from CoreLogic or from other data sources. So happy to send that to you, Glenn, and chat offline about that one. Another one is asking, thanks for the answer, what advantages, disadvantages we direct property investment, that is REITs, or would you recommend get out of blue stock chips and get into property? Well, I think the first caveat is here, Alan, is we can't give financial advice unless we know someone's personal situation, and we won't do that. But I think it's very important to get good advice, number one. It's really important to speak to your advisors who are appropriately licensed to give advice on that. But each asset class has its merits. Obviously, if you're looking at the share markets and equities, it's a different type of investment to investing in property. So it's about looking at the long-term perspective and getting a property investment that suits your personal needs and objectives is what I'd answer for that one. Alan, question for you: how much of a drop do you see in commercial property?
I worry. The reason I worry is I'm not sure that a lot of, let's say 60% come back. I think, you're probably not going to have 100% come back in the CBD. What we see is a consolidation. So NAB, for example, has closed about 3 or 4 buildings and we're all in one now. And so that's great if you own the A-grade building. It's not great if you don't own the A-grade building. And so I actually think you could get fairly large falls in commercial property in the B, C, D sort of areas of commercial property. And I think you also have problems in some areas in terms of retail in CBDs. A lot of the firms that we know of in the retail space in the CBD are signed up for what they call inflation plus rents. So if I'm saying inflation is 8% and they've got a +1 on it, they're just going to have a rent rise of 9% this year.
Wow.
Okay. So you just have to be careful. The only one that's doing really well at present is industrial. It's very strong. A lot of it's industrial in layman's terms is I'm building sheds and warehouses where I store my stuff online. There's distribution centres. They're doing really well.
Well, we do have a commercial division within Propertybuyer, and we're kicking some really good goals in that space. We've just transacted on a couple of warehouses recently, but very hotly contested, very difficult to find.
Yeah, everybody knows it.
Oh yeah, so everything we do in that space is off market. So yeah, challenge. I'll ask another question here. How has China been defined as an emerging economy so as to receive money from advanced economies like Australia?
Well, because there's a lot of benefits to be called emerging. And, I don't think they're emerging anymore, but that's the way they are defined under the World Trade Organization. So, in other words, they've got a very young population, they're growing very fast, and they sort of fit into that category. So that's the break sort of thing. And, for me, the second biggest economy in the world shouldn't be emerging.
Yeah, okay. Someone's asked, Rich, what should an investor looking for 5 properties in 5 years think about with regards to diversifying across different states? Yeah, well, look, I think setting a goal of 5 properties in 5 years is great. Number one, make sure you can afford that. Speak to your bank or finance broker to make sure you can get the loan. But definitely investing in different markets is a great way to go because number one, you minimise your land tax across different states. It was great that Queensland, the idiot Queensland government decided to think about closing that stupid thought about that. It was almost double taxation. Honestly, that land tax thing, I'm so short-sighted. But yeah, look, definitely buying in Victoria, in New South Wales, Queensland, and other states is a great way to go. We can help design a portfolio plan for this particular person who was asking that question to make sure you're going to really maximise your opportunities. And there's not a one-size-fits-all. If you're on a higher income, you potentially can go for higher growth properties. If you're on income of like 80 grand or less, and you need to really think about creating a positive cash flow strategy, then we're going to be putting you into different locations. It really depends there. I think we've got about maybe 1 or 2 more questions, Alan, but you've been very patient. So I'll just quickly think, here we go. Which one will we pick here? So you want to pick one? There you go. Here we go. Thoughts specifically around commercial property. Oh, hang on, let's do that one. No, international. Sorry, I missed one here. International equities versus Australian equities. Do you have a particular view, Alan?
That all depends on the currency, put bluntly.
Okay.
And so I feel very humble in my ability to forecast currencies. But it's a little bit like a diversification strategy. You won't get it all right, but don't just put them all in one country. So if you, against the euro, for example, Australian dollars really hasn't changed for ages. So it's a diversification play, I suspect, is really the story. Yeah.
Okay. All right. One last question. Someone here's asked me about, I mentioned regional regret. Would you see the migration to regional cities would stop, hence price would be negatively affected? Look, I don't think so. I mean, Alan, you tell me your thoughts, but I think the flow of people out of the city to the regions will slow. It won't be quite as strong as what it was when we had the lockdowns. I think there'll be some natural pullback across the board like there is, but I still think there's some great regional cities to invest in. For me, I like to invest in places like Toowoomba or Newcastle or Ballarat or areas where they've got a really diverse economy, not somewhere like Moranbah that's just totally dependent on just a mining industry alone. What would be your view on regionals, Alan?
Pretty similar in the sense that, I think people like the ability to work at home. And that's seen very big increases in non-capital city property prices. And so far we're seeing, agri still doing really strong. And so I don't think it's all going to sort of dry up and go back the other way. I think it'll probably stabilise, but it'll stay high. So I'm pretty similar to you, Rich.
Right. Excellent. Well, look, thank you so much, Alan. You've been very patient, very diligent, and very insightful. Thank you once again for all your great knowledge today. Everyone online, I'm sure, is giving you an applause, but can I just say to everyone online who's logged in today, thank you so much for joining us. We will be sending around a copy of the slides, and please share that with your family or friends. And I want to wish you a very safe and happy Christmas. And if you do have any inquiry to consider using our services, we would absolutely be delighted to chat with you further. And please make contact. But for now, wishing you a very Merry Christmas. Thank you so much. Thanks, Alan.
Okay, thanks, Rich.